Mike Muller, head of Vitol Asia. Mike, throughout the events, conferences, energy gatherings that I attended in Q1, the dominant was this is the year of two halves. The first half will from a demand and an energy price point of view, would be somewhat sluggish. The global, G7 slowdown, China not quite recovered yet. And the second half would be the bumper. Your views on, does that narrative survive the first quarter, and your reflections on Q1?
Yes, I think that narrative probably is still most people's house view, but it is so much a function of Chinese demand rebounding, and China needs the global economy to cooperate in terms of providing markets for its exports, which is still a big part of the domestic economy. We know that in China, the property sector requires a fair bit of kickstarting still. And I think we are beginning to see some encouraging demand data, which still defies expectations. It is very, very robust. And of course, two sets of consecutive monthly PMIs that are at both basically the highest data points in the last 2 years. Not surprisingly, of course, given the history. But on that basis, there is still a lot of hope that China will return to consuming pre-COVID levels in those sectors where it still hasn't quite caught up, notably aviation, of course. And China has, with rather little notice, now opened up foreign markets to domestic tour groups, and is now dropped all barriers for foreign tourists on top of the business travelers that have been able to go to China for the last 2.5 months or so. So on that basis, you'd expect to see things picking up. That said, I was in China twice in the last month and a half, and Beijing International Airport is still a pretty quiet place. The duty-free shops are closed. So that is not yet to full potential. But for the bulls out there, it obviously reassures them that demand is yet to come, because there's a lot of capacity to be filled out, a lot of pent-up demand. But Christopher's quite right in saying there's not the same pent-up demand for holiday travel, because whilst China is a society of people with a propensity to save, at the same time, there haven't been the handouts. And we mustn't underestimate that China has not been spared, despite the fact that many of their enterprises are public sector, but they haven't really been spared the industrial closures and other impacts of COVID also, which have put a hole in parts of middle-class China and arguably arrested the acceleration of lower middle working classes into middle-class society in China, which is the strata of society that starts spending not just on consumables but also on international travel. So that's the China side of things. In terms of Q1, I mean, it's ended with a bit of froth, right? Because Brent pretty much touched $80 on expiry. Please don't look at the May contract which expired, because that isn't necessarily representative. It hit $80. But the dated Brent quote was at 79, and that's you mentioned the Goldman Sachs buy of the dip. I mean, were they referring to the $71 10 days ago, or do they still think this is part of the dip?
Well, their correction on their call for the year, they did revise earlier in March, which was down from over 100 to I think 94, 95. So that in order to get an average on 94, 95 on Brent, you're going to have to see some big moves to the upside.
Yes, I mean, the consensus is out there. A lot of people, a lot of conferences, as you say, over the last few weeks have put out numbers that are north of 80 or even 90 for the second half of this year, based in part on what I just mentioned. But of course, then we had this little financial shock, which took everything down with it, because financial instability does, and of course, high interest rates do hit small, medium businesses pretty hard and hit consumption. So there was a major crisis of confidence from which oil markets were not spared. The oil markets pretty much took the view that fundamentals in oil had not changed. And then there were a bunch of ingredients in recent weeks that overlaid that. The messaging from the US that they were not likely to refill the SPR for mostly technical reasons. The ongoing strikes in France and how that's hitting refineries and therefore crude oil demand into France, largely sweet crude, but also, of course, product output. And then finally, some production beginning to be shut in as a consequence of the aftermath of the Paris ruling that the Kurdistan regional government is to observe longer-term treaties and essentially hand back control of marketing internationally of their crudes to Baghdad. So those are the facts that ended up setting sentiment towards the end of the quarter.
the last time we had the chance to talk together a month ago, we were talking about the impact or the newly introduced price cap on products by the G7 and the sort of sanctions on Russia, crude oil in December, then products in February, and you had indicated that it might lead to a lot of oil being sort of sitting on ships as lawyers worked out the legalities of everything. How did the first quarter progress with the adoption of these price caps and their impact? It seems everything moved smoothly and it was a non-issue. Is that an incorrect perception? How do you see it, the first quarter on that point?
Work in progress, I guess the answer, Sean. There were a couple of other strands just to build the picture out. There was the declaration by Alexander Novak that Russia would take 500,000 barrels off the market, which initially didn't look like it was going to be the case. Then there was speculation, would it be products rather than crude? It does now appear that it is to be crude. And then there was also the messaging around CERAWeek in Houston by the US government, observing perhaps that there were now flows that were quite okay and legitimate for the conventional household name participants in the market to start re-engaging in. So clearly the caps were set at levels which permitted some trade. The market has had to find ways of working its way through the assurances, which if not observed by the three service providers we talked about last month, namely the banks, the insurance providers, and the shipping companies, would result in sanctions on those three entities for allowing Russian trade above price cap. So in the knowledge that those assurances are not forthcoming from the source in Russia, it then follows that there had to be a margin of reasonable error, if you like. Maybe I'll put that differently. There had to be no doubt at all that the prices of cargoes that are being treated as below the price cap and therefore availing themselves of G7 services in those three supports segments are definitively below the price cap. When prices fell $10 after the failure of Silicon Valley Bank and then Credit Suisse, we obviously had plenty of room to maneuver those price caps. There was then the middle of the month, at which time some participants expected a potential recalibration of those price caps from the G7, which didn't eventuate. So we now have a situation where there are certain products that are flowing quite easily below the price cap. Imagine something like diesel, for example, at a time when Brent was at 70 and therefore Russian crude was well into the 50 area. That gave you $50 of room for distillate cracks, which of course are no longer at $40, $50 a barrel. They're more like teens 20. As a consequence, there's plenty of room for maneuver, and companies have found ways of dealing with those flows, largely, however, to Asia, because we have to remind ourselves the price cap came on top of an outright import ban into G7, which includes all of Europe, right? So the biggest single change was a redirection of flows. And that you hinted at this at the beginning, the expected stock build on the water. I think it's fair to say the stock build on the water has been a little less than some predicted, but it is still there. And people are commenting in many ways about that. But the other thing that seems to be happening is transshipment and staging, whereby flows of these barrels are moving into jurisdictions which are happy to store them and then either consume them or blend them or swap them out. And the combination of those three things, a country that has a capability to take in Russian flows, doesn't have sanctions, and then exporting more of what they make themselves, that has been the largest regulatory mechanism to keep the oil flowing. And of course, everyone, including the people that spoke at the CERAWeek in Houston, recognized that the large portion of Russian oil must continue flowing in order to keep oil markets stable.
And the redirection, I mean, we're seeing flows even coming into the Middle East here and the Gulf and being others moving out. This idea that you take in Russian oil, you tweak it a bit and you send it to G7 markets. Is that of scale? Is it a marginal?
Not G7 markets, Sean. I think that's still an issue because tweaking a bit is there are some pretty strict rules around that. Transformation by processing is what's required, or by blending to a point where the CN code or the HS code in whichever jurisdiction you are changes, which for many products makes it impossible to just put it in a tank and tweak it a bit. So I don't think you're seeing very much Russian oil going into storage in the places you refer to and then make it back to G7. Most of it will make its way onwards to Asia.
your thoughts on the second quarter outlook. Where do you see things going? Obviously, the if we are to see the year of two halves, we're going to have to start seeing it in Q2, or the IEA is going to have to start revising down its fairly robust bullish forecasts on demand growth, which they've put at well above 2 million barrels for the year.
Everyone's expecting Q2 to be relatively calm, but the last 6-7 quarters have shown us that there are many twists and turns to be had. I mean, Christoph has highlighted one, which is the military arena in the Ukraine. And he's also highlighted the other, which is the possibility of more poorly managed banks causing embarrassment to governments. But ultimately, I think we have a very large set of numbers, both on the demand and the supply side, in terms of year-on-year demand and growth and supply growth change. 1.6 something million barrels per day of extra supply growth, a lot of it from non-OPEC, which is investments pre-COVID coming to fruition in places like Brazil and Guyana in the West, etc. And then on the demand side, you've got this massive number of either side of 2 million barrels a day, according to various consultants out there. And any small change in that is big deal in the context of historical years. So we're still dealing with large numbers, with large potential variations, and therefore the prospect of more volatility. International travel in and out of China alone, whether it's a slow fuse or it happens rather suddenly in the space of the next few weeks, has the capacity to change jet fuel demand by 100, 200,000 barrels a day. That's a big deal. So we have to see.
Mike, just to follow up, the other event that's happening in the second quarter, it's more of a structural pricing thing, but I wanted to get your views on it. Dated Brent is going to embed WTI into its architecture. And I'm wondering, is that significant from your perspective? Is it a big change moment for the markets and its actors?
I think obviously now the June contract is the first contract that has that, but we've been trading June for many months already since the methodology change was announced, and therefore the market is prepared for it and everything should be in the price. There were some technicalities around the actual terms and conditions whereby Midland crude can only be delivered on a certain size of vessel into European ports, Rotterdam. But again, those fine tunings are not material to the change, which is that you have a very large amount of Midland that now sits as a cap above the established grades of 40s, Ekofisk, etc. in the North Sea, and add to an extra pool of liquidity. The intention, of course, was to address the decline in the underlying base of benchmark setting crudes in Europe. This is the biggest volume supplement by far, and the intention is that Midland will sit above those grades in terms of value. When there are occasions that is not the case, if Midland is the cheapest of those grades, then of course it'll be rather interesting. And it'll take quite a lot for it to be the cheapest, because you have to ship it from the US to the North Sea, transship it onto a smaller vessel and get it into Rotterdam and then net things back. But yes, it does portend a little bit more stability in the benchmark. And I think the trade is ready for that, and on the whole welcomes it, because the deeper the liquidity, the more reassuring the benchmark is for people that want to hedge, and in particular for people who want to put long-term trades on for inflation hedges or portfolio hedges or relative value trades in the financial sector.
So just to follow up, the other reason was, at least a part of that, because we're seeing so much US crude moving into Asia, that the Brent as the global benchmark needed to reflect this new flow of US crude moving into Asia, which has reached up to some 3 million barrels going exported from the US. I wonder if you could just speak to that. Does that still make sense now, given this whole new energy flows that have come in that were not at least in the picture when this was announced first, i.e. all of this Russian oil coming into Asia? I'm just wondering, structurally, does that still make sense as a reference?
Until your very last sentence there, I wasn't quite sure I agreed. I mean, world just balances out, right? The American oil by Europe and goes straight to Asia, of course, and that will continue. But yes, in a world where more Russian oil is forced into markets like China, the ability of China to take US crude is diminished because the mass balance doesn't permit it, right? So you're right. In that sense, it's possible that you could see a bit more Midland crude having to compete for markets in the Atlantic Basin. But that's the beauty of markets. They will balance out, and the market price will be set accordingly. So I think having Midland there as part of the Brent formula determining mix is generally something that is good and welcomed. Yes.